Web3 central banks, the role of Layer 1 blockchains in issuing and managing digital currencies. Introduction. Blockchain technology is redefining global finance by enabling decentralized, programmable money. No longer confined to cryptocurrencies, these systems now host fiat-backed digital currencies, offering new possibilities for financial inclusion, cross-border transactions, and global commerce. At the forefront of this revolution are Layer 1, L1 blockchains, foundational platforms like Ethereum, Solana, and XRP Ledger that are emerging as the infrastructure for a multi-fiat stablecoin ecosystem. By facilitating programmable digital money, L1 blockchains are beginning to rival the traditional roles of central banks. Multi-fiat stablecoins, the key to global financial inclusion. The concept of multi-fiat stablecoins. Stablecoins are digital currencies pegged to fiat currencies such as the USD, EUR, or JPY. These tokens combine the stability of traditional money with the efficiency of blockchain technology, making them an essential building block for decentralized finance, DeFi, and digital commerce. Current dominance of USD-backed stablecoins. The rise of USD-backed stablecoins like USDT, USDC, and RLUSD has cemented the dollar's position as the de facto reserve currency in Web3. These stablecoins facilitate cross-border transactions, remittances, and DeFi applications with unprecedented speed and cost efficiency. Expanding beyond the USD. While USD-backed stablecoins dominate, there is untapped potential in creating fiat-backed stablecoins for other major currencies, such as the euro and Japanese yen. A multi-fiat stablecoin ecosystem would enable users worldwide to transact in their preferred currencies, reducing exchange costs and fostering global trade. Decentralized Forex markets. Multi-fiat stablecoins can power decentralized Forex, foreign exchange markets. On-chain liquidity pools and decentralized exchanges enable real-time, borderless currency swaps without intermediaries, democratizing access to foreign exchange trading and creating efficiencies that traditional systems cannot match. 3. Implications for the global economy. Redefining the role of central banks. L1 blockchains are not limited to issuing digital dollars. With the right regulatory compliance, they could expand to issue digital euros, yen, or even multi-currency baskets that act as decentralized alternatives to traditional financial systems. Challenging sovereign monopoly over money. By enabling cross-border, fiat-backed stablecoins, L1 blockchains challenge the historical monopoly of sovereign nations over money issuance. This creates an open financial system where currency isn't tied to geography and users have greater financial freedom. Financial inclusion at scale. Traditional central banks have struggled to serve the unbanked population globally. L1 blockchains, as decentralized financial systems, remove barriers like national borders, credit scores, or access to banks, empowering billions with financial tools. The evolution of stablecoins and Layer 1 blockchains. Fiat-backed stablecoins, the cornerstone of trust. Stablecoin issuers must hold reserves, e.g. USD, government bonds, or equivalent assets, to back the issued tokens. Regulatory oversight ensures these reserves are maintained and verifiable, giving users confidence in the one-to-one peg. By adhering to regulatory frameworks and obtaining licenses, stablecoin providers build trust among users, banks, and governments, reducing the risk of legal challenges. Layer 1 blockchains as decentralized, borderless central banks. Layer 1, L1 blockchains like Ethereum, Solana, and XRP Ledger are evolving beyond mere infrastructure for transactions and smart contracts. By hosting or directly issuing stablecoins, e.g. RLUSD, USDT, USDC, they are effectively operating as digital currency platforms, akin to central banks in the Web3 ecosystem. Key features that enable this rivalry. Decentralization. Unlike traditional central banks, which are tightly controlled by governments, L1 blockchains operate on decentralized consensus mechanisms, reducing single points of failure and political interference. Interoperability. Blockchain ecosystems are increasingly focusing on cross-chain communication, ensuring seamless interaction between assets on different blockchains. Smart contracts as policy tools. Algorithmic smart contracts on L1s can manage supply, distribution, or inflation of programmable stablecoins, mimicking monetary policy tools. Global inclusivity. L1 blockchains are borderless, enabling anyone with internet access to interact with financial services, democratizing access. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. V. Implications of multi-currency digital money, decentralized global reserve system. The dominance of USD-backed stablecoins suggests the digital dollar is currently the reserve currency of Web3. However, as multi-fiat stablecoins grow, this role could shift toward a basket of digital currencies, representing a decentralized alternative to existing reserve systems. Real-time global commerce. Multi-currency digital money removes barriers to trade, enabling instant payments across borders without intermediaries or lengthy settlement processes. This fosters greater efficiency in global commerce. Threat to traditional financial systems. Central banks and financial institutions could view blockchain ecosystems as competitors. Increased regulation or the development of central bank digital currencies, CBDCs, may arise to counterbalance these decentralized systems. Counterpoints and challenges regulation. Governments and traditional central banks may resist this paradigm shift to maintain control over monetary policy and financial systems. Acquiring money transmitter licenses for non-USD currencies might face political resistance. Fragmentation. A proliferation of fiat-backed stablecoins could lead to liquidity silos, making interoperability critical to avoid inefficiencies. Decentralization versus centralized issuers. While L1s are decentralized, fiat-backed stablecoins are often issued by centralized entities, introducing trust dependencies. A decentralized global central bank. A multi-fiat stablecoin ecosystem would, in effect, act as a decentralized global central bank. Instead of relying on national central banks and traditional banking systems, people and businesses would interact with L1 blockchains to issue, transact, and store fiat-backed digital currencies. These stablecoins reflect the value of real-world currencies, while blockchains serve as neutral, borderless platforms for global financial activity. Conclusion and closing thoughts. L1 blockchains are increasingly acting as decentralized, borderless central banks in the Web3 ecosystem. While they currently focus on USD-backed stablecoins, there is no technological barrier preventing the issuance of multi-fiat stablecoins. This represents a profound shift in how money is created, stored, and transferred, ushering in a global, decentralized monetary system that could rival traditional central banking. The idea of a multi-fiat stablecoin ecosystem is not just speculative. It represents the logical next step in the evolution of blockchain-based finance. It has the potential to reshape the global monetary system, offering greater efficiency, inclusion, and innovation. If executed properly, it could pave the way for a truly borderless and decentralized financial future.